to another Marnie and Michael Monday. I'm so glad that you're enjoying these. This one is all about Michael's expertise. I have basically nothing to say.
Oh, that's not true. This is about home buying, and you're an expert in shopping for homes and finding homes and looking at homes. You got a lot of friends in the business, so.
Yeah, like you. So what I wanted to touch upon very briefly, without embarrassing Michael, is I'm going to toot his horn and just tell you that his background the last 10 or more years in the law was all about mortgage litigation. And so he saw everything that could possibly go wrong. So I think there's no one better to talk about how to buy a house and what to think about on the practical side than this guy.
Yeah.
So why don't you just...
Well, I think maybe Marnie and I were kind of brainstorming about, home buying. It's a topic that applies to just so many people, but it really applies to people who for the very first time are considering buying a house, maybe their first home. Could also apply to baby boomers, people who are on the cusp of downsizing or, thinking about changing from what had been historically a family home where they raised kids to something different. It's also for, kids, older kids who are trying to help their parents navigate through retirement, moving into retirement communities or condos. That's all about purchasing a house. And it's also for, Generation Xers out there who are, in a house maybe, or in maybe a starter home or two, and they're really moving upward and they're looking to upgrade. And so, what we wanted to talk a little bit about is, buying a house to live in. Obviously, some people purchase real estate for purposes of investment value, to rent it or to upgrade and flip it. But, we thought maybe the appropriate topic today would be to talk about buying a house for residential purposes to buy. Yeah. So really 3 main points that we wanted to cover. Marnie's going to cover the first one, location. Location. You hear about it. It's not actually the only thing.
No.
So location being one, but the other two factors, price, and it's a lot more than just the actual purchase price of a home that folks need to be aware of. And then my area of expertise from a technical perspective is that of financing. How do you get people into these houses in an affordable way? Getting people into what I consider to be a rather unenviable position as being a borrower on a bank loan. But it's kind of a means to an end. And so talk a little bit about the way people can think about going through the financing process. So why don't we start with the fun stuff first, which is looking at the physical house itself and thinking about things that are important. Obviously, location being one of those.
Everything I'm going to say is probably obvious, but I'm just going to run through
it. While you do that, I'm going to let Wrigley out.
Okay. So location is huge. The bones of a house, the physical structure, that it serves the needs of your family, that's all well and good. But if that house is in the wrong school district for your kids, and when I say wrong, I'm not saying one's better than another, but there may be features that you're looking for in your school district or specific high school or specific elementary school size, student-teacher ratio, access to special services, athletics, whatever works for your family. So school district, I think, is huge, even if you don't have kids.
Yeah,
because
absolutely.
Our next house that we'll buy sooner than later, we're still discussing that. But our next house that we buy, if and when we do buy a new house, obviously we will not be worried about the school district. Our kids will no longer be in school. But I want my house to sell again at some point. And so I want to be in a school district that's desirable and has a quick selling time.
Yeah.
So look at everything that you can around you.
Yeah. So it's just not the location, right? It also is the structure of the house, how it's set up,
right?
Whether you want to have a master downstairs. If you have kids, whether or not you want to have the kids separated physically from you.
Can I talk about that?
Yeah, absolutely,
okay.
You should.
Here in Texas, a big thing is to have the master bedroom downstairs and the kids' rooms upstairs. And so many people I've heard say, oh my gosh, from up north that aren't familiar with that. I could never do that. I want to be close to my kids when they're little itty bitty. You got to think more long term. At some point, sooner than later, your kids will sleep through the night. And for a few months, it might be inconvenient. But trust me, when they're bigger, you want separation. You want to be as far away from them as you can be.
Yeah.
So, if you're going to be in the house a long time.
Right.
So, no matter what your situation, think about 5 years, 10 years, 15 years down the road, what your family's going to look like, how many members of the family, pets, that kind of thing. Don't get too caught up in the immediacy of, is this right now? It's, will this still be good 5 or 10 years from now? Because you don't want to buy your dream house and within a year go,
Right.
this isn't working. It's
Yep.
too small,
Yep.
it's too big, it's too this, too that. Okay, I'm
Okay.
done with location
Well,
and the house.
Yeah, so you found a perfect house. It's great square footage. It seems to tick all the boxes in terms of location value. And then the question is,
Can you-
what about price?
Yes.
And it's not just about the purchase price, that you may be able to negotiate down to something that you think is a good deal relative to the market value, but it's the hidden prices, I think, the hidden costs that are associated with home ownership that I think a lot of people don't really take into consideration, even for long-time homeowners. And I'll give you an example. So I've been working for an entity in Texas, and a lot of people were relocating from California. They were going through a relocation process, bringing a lot of the employees into Texas. And so people were moving from California in areas like the Bay Area or in Los Angeles or Orange County, and you would think, oh my gosh, the housing out there is so much more expensive than it is in Texas.
It is.
That they must be thinking, this is a huge windfall. We're moving to Texas. It's the
Buy a house
greatest
for
thing. I
cash.
could buy $1 million house. I got cash that could afford a lot of it. And what they didn't take into consideration is that in Texas, while we do not have a state income tax, we have a relatively high property tax assessment, especially when you're in a developing and pretty good school district, which is a big line item on the tax. And so these folks, many of them in fact, were moving in and buying the houses in Texas and thinking they were getting these big 5,000-6,000 square foot houses with
for a
an
little bit.
acre or two lot. And then they got their first tax bill and they were totally blown away, and they really were not equipped because as Marnie and I have discussed previously, talking just generally about finances, we like to set up budgets. We have a monthly, quarterly, and annual kind of line items of amounts that we have to pay, and one of those is property taxes.
Big line item.
And you can get underwater quickly on a tax. So property taxes, that's a lien against your house that the county or a school district in certain jurisdictions have against your house, and it's foreclosable. And so that's a scary proposition. If you can't afford to pay your property taxes, even if you can afford your general mortgage payment for principal and interest, that property tax in and of itself becomes, an impediment to actually being able to get into that house. So, but that's not the only thing. Think about all the general MQA type budgetary items that have to now get infused into your life. If you're moving from just being a renter in an apartment, for instance, you don't necessarily pay a homeowners association due or a condo due. You don't pay property taxes. Nope. You pay a different type of insurance, the premiums of which are much lower when you're a renter than they are as a homeowner. You may want to have an umbrella policy because when you own a house, you now potentially become liable for injuries or things that might happen on your property. If you have a pool or if you have a sport court, if you have different things associated with your land that you own, you got to think about insurance. You got to think about landscaping. You got to think about utilities. Things that you pay as a homeowner in terms of utilities are different than what a landlord or an apartment complex or an apartment building might pay for as part of your rent. And so as a consequence, it's not just about the price. I would implore that when people are thinking about home ownership, they study what would the average utility cost be? Is there a condo association or a homeowner association? What does that look like quarterly and annually?
I'm laughing, I'm smiling because I've been pushing Michael. I want to move. And I love our house, don't get me wrong, but at this stage in my life, I want...
Of course, Marnie's wanted to move every...
I watch House Hunters, I look at the model homes.
Basis.
I want a bigger house, I want a more custom house, I want a bigger lot. And Michael's like, that's all well and good, sweetheart, but even though we could possibly bump up to the next level in house price, look what the taxes are like. Look at what the utilities on a house, another 1,000 square feet looks like. And I realize, like, thank God I'm married to him, because
I don't know about that, but
there's that stuff you don't think about. Like, okay, fine, I can handle the mortgage, but oh my gosh, those taxes. Or oh my gosh, double the utilities.
And sometimes when you're thinking about a home purchase, you may actually convince yourself that maybe it's overrated, because the investment value of a house, I would say, except for very unique instances in time historically and in unique locations, at least in America, which have been fleeting in time. It's not a good short-term investment, and arguably, it's really not even the best long-term investment. The return on that investment is questionable at best. It may stay steady, and that's decent, or it goes up, just a mere percentage points or two. over a longer period. And so really it's not the greatest short-term investment is certainly not really the greatest. There were jurisdictions in America, in Arizona, Nevada, California, and Florida in particular, during the early to mid 2000s, where people were kind of making a killing just sitting in a house that was going up exponentially in value. But, a lot of that was a little bit artificial in terms of how the markets were valued.
Yeah.
And the reality is the conservative play is that you really should not be looking at your house with any type of a short-term investment value. Some people like to buy, late night commercials. They'll go on and they'll tell you about buying foreclosed homes, and they'll fix it up real quick and flip it. There's a lot less of that actually being successful than than is what is reported. And so, as a consequence, I would probably caution people into thinking that, purchasing a home and all that you have to outlay is going to translate into this amazing investment. I would say the caveat would be if you're buying it as a non-primary resident and you're looking to rent it out, you may be able to pick up a rental stream there. But even then, you got some serious overhead that you got to consider. So we probably spoke a little bit longer than we wanted to on the first two topics.
I like
location,
it. It's interesting.
And what I call price plus. I'm sure Marnie will put a little blog or something to describe this a little more, or something.
No.
Okay. If not,
I don't have any time
I'd say
to
it's
speak yet,
price
sorry.
plus. It's more than price.
Maybe later.
And then you got to think about financing. Like I said, it's not really the best investment. So the question that you have with home ownership is, if it's not the greatest short-term investment and the long-term investment value is probably average to below average, then how do you convince yourself that you need to part with some money because you got to make a down payment? And so it's a dilemma. I would say it's an absolute dilemma. The banks in America are going to largely require that there is built-in equity at the point of purchase, because the banks are taking an interest in your land. They're taking a security interest. Your house and your land becomes the collateral for the loan that they're going to give you, and it can't be 100% financed. So these days, banks require 15 to 20% down, which creates about an 80% loan to value ratio, maybe even less depending upon people's credit scores. And so, as a consequence, what you're dealing with right now is you're dealing with the prospects of having to come up with some significant amount of money that you're not going to be able to use for other investments or other savings. And it has to be given, to purchase the home, basically. So right back into your house. And that's a dilemma because, like I said, people, when they study this and get away from the emotional connection of being on title to a property, actually having an interest in the land on title, they have to convince themselves that, it's okay for me to part with this money and get into it. Yeah. But then you have the remaining amount that you need to figure out, and the banks will kind of offer you products, mortgage products that Marnie was alluding to earlier. And you need to kind of determine what kind of product do I want to get into. Today, right now, the interest rates are relatively low. They've been low for the last several years. But, in a year from now or 2 years from now, they're going to come up again. It's cyclical. The government in America has been kind of artificially suppressing the interest rates, but it's not going to last forever, and it's on the uptick, certainly on the horizon.
Which is not always bad for other investments.
It's not always bad, yeah. So what I would recommend in a very general sense is that you got to get over the fact that there's a dilemma about the home not being a great investment. If you've convinced yourself with your family members that you want to buy the house, then you got to put money down into it. And the question is, do you feel comfortable having a low equity position or a higher equity position? And I always feel like you want to, in purposes of having a residential house, at least the one that is your primary residence, you want to have as much equity as you possibly can. Psychologically, it helps us sleep better at night.
This is us. This is what we think.
Exactly.
Yeah.
But what it does in the real estate market and in the banking market is that it creates options. The consumers that don't get caught behind the eight ball are the consumers that have options. And in the world of home ownership, you have options when you have equity. And so if you have the ability to start out of the gate with, something like 20 or more percent equity, that's an 80% loan to value ratio or lower, 80% or lower, that's good. And so the lower you are, you have options in terms of the type of mortgage product that you want to get. So you hear a little bit, my final point right now, and we can talk about this in greater detail if you have questions, but mortgage products generally come into two types of classifications. One is a fixed rate loan. When you get a fixed rate loan, whether it's for 15 years or 20 or 30 years, that fixed rate loan is going to create a monthly payment of principal and interest, and that dollar amount is the same for the entire loan. So it creates predictability.
I like that.
When you don't have options, or when you feel like you're a little bit hamstrung or handcuffed in terms of options in the world of home ownership, that means you have a little bit but not a lot of equity. You probably want to have predictability, because if you don't, then you could have some issues as market values fluctuate. So if you're low on equity, you want to increase your predictability. In my opinion, you want to fall more into the fixed rate loan category. If you've got lots of equity, 50% equity, 60% equity, maybe not that much, but maybe something of a close to half loan to value ratio, you then have lots of options, because even if the market goes south, it's not going to impact your equity position too much unless you have an absolute recession of the likes that we had in 2008 and 2009. So we're thinking that's not going to repeat itself anytime soon. But for instance, you may want to have a lower out-of-pocket on your interest payment. And to do that, you're probably going to be better off having a variable rate or ARM loan. And you can probably afford to do that, especially when interest rates are low. So if you were to value the interest rate on a fixed rate loan today versus an adjustable rate loan that's tied to a moving index, that adjustable rate loan is going to have a lower interest amount, so your finance charge on that loan is going to be less. The fact that you have equity means that even if interest rates go up a little bit, and you can watch this trend, you would really be a good candidate to do a refinancing. So if the interest rates start to go up over a period of months or years, you may want to consider at a certain point refinancing into a fixed rate loan to gain that flexibility. But you can only play around with that type of a game if you're somebody that has options, and that somebody would be somebody that has significant equity. So that's kind of the comments that I would make. Generally speaking, when you're looking at financing, it's going to be tied to a fixed rate loan, or it's going to be tied to a moving index that changes monthly, and it's going to impact your interest that accrues on that loan.
Those make me really nervous. I'm
They
sorry.
do, but you can deal with the nerves a little better when you've got tremendous ownership equity, investment equity in your home. You'd be really nervous if you're somebody who doesn't have a whole lot of equity and you have an adjustable rate mortgage.
Well, that's what happened in 2008.
That's right.
California.
It happened to people in Florida, in California,
Nevada.
outside of Vegas, in the Scottsdale, Phoenix area. Those were high investment areas where prices were going up really quickly. Market values were increasing, like I said, almost artificially high. For people that were stuck in adjustable rate mortgages and they wanted to get back into some level of predictability, you could be in trouble, because when banks make a decision about whether or not you're going to be eligible for a mortgage, they look at two factors, and they both have to be satisfactory to the bank. And those are the value of the property. There's got to be a cushion in the market value, so the collateral has got to be sound in terms of value, and then you yourself have to be creditworthy. So what happens when the real estate market starts to drop is your loan to value ratio starts to go up. In places like California, Arizona, Nevada, and Florida, those values went down so much that the loan to value ratio actually went over 100%. In some instances, we had empirical examples of 150, 200% loan to value. You are so underwater. And so even if you had a bad mortgage product that wasn't satisfying your interests, because sometimes adjustable rate mortgage products have different components to them that could cause payments to increase over time, and you wanted to get out of that, so maybe it served its purpose for a few years, but you want to get out of that predicament, you are left with no solution when you've got a property value problem. And so that's why I said
He loves this.
I could go on forever. The bottom line is
on for 20 minutes.
Marnie knows all about location and different factors associated with it. You got to think a little bit about price, but don't just focus on the purchase price of a home. That's a real Achilles heel that a lot of families have suffered through, unfortunately, in America. And then financing is a complicated game. I tried to distill it down to just 10 minutes, but that's a conversation that needs to be analyzed.
And I would add that, and tell me if I'm wrong.
Sure.
I would say don't listen to what the bank tells you can afford. You figure out what you can afford, because
yeah.
they are it's a business. They are not your parents. They're not going to tell you, oh, this is really, no, they're trying to make money. That's what they're supposed to do. This
Sure.
is what capital
Yeah.
ism, thank you, looks like. So they're going to try to make more money off of you than
Yeah,
you can necessarily afford. So you need to go in with a firm number in your head.
I think that's generally right. Although underwriting in America has gotten
It's
more
better.
regulated over
Yeah.
the years, and so it's a little bit more conservative. But to Marnie and I should say, and people like
you
us,
got it right the
it's
first
not conservative enough.
Right.
You know what I'm saying? So I know what makes me feel good at night, that I can go to sleep and feel comfortable without, being concerned about those kinds of things, and Marnie does too. And so we just err on the side of being conservative. And I think in the world of real estate, especially with a primary residence that you're going to use as the home that you're going to have your family in, raise your kids maybe, or at least enjoy each other's company, you want to reduce and mitigate against, the potential risks.
Yeah.
And so we like to be conservative on that.
Well, I hope you like this. I found it fascinating. I understood about 65% of it.
Yeah, this would be eligible for a follow-up
Yes,
blog.
so if
Blog.
I will work on that. You're going to write the blog.
I could dictate it to you. How about
Okay, that sounds good.
Yeah.
But honestly, I know he covered a lot of very technical things. So if you have specific questions, please leave them in the comments below. We will try to, when I say we, I mean
Not offering legal advice, but
No.
just offering friendship recommendation.
right.
That's about it.
We could do it he could either do it in a blog, or maybe we could do an FAQ, or answer your questions about housing and stuff. We
Generally,
are going to get
yeah.
back. This is probably part of our budgeting series, I guess. So
I guess it is a little bit. Although Marnie kind of had a hankering for looking at homes recently, so it made sense to
yeah, and he
kind of
squashed
think about
that
these
like
factors.
a bug.
No, not at all. When it matches up perfectly, it's good to go.
All right, we haven't found that
We'll
perfect
see.
match yet. Anyway, so thank you so much for watching, and we'll see you in the next one. Don't forget to leave your questions and helpful comments down below. Thanks for watching.
Thanks for watching. I think I had more fun than y'all.
Say goodbye.
Bye-bye.
Bye. Good morning. It's Sunday. It is 6:30 in the morning, and I'm getting ready to fly to Chicago to perform my brother's fiance's wedding shower.